Hello and welcome along to another Property Live here with us at Opus Partners. We are so pleased that you are here with us today, and I'm just sorting my wee technology. Now, I always like to start these webinars off by making sure that the sound's working, that I am neither too loud nor too quiet. So let me know down in the comments section, can you hear us okay? Is it too loud? Is it too quiet? And I will have a little look at your answers as well. Yes, good to have you here,
muffled.
Bryce. Wade here as well. Who's saying muffled?
Someone said muffled. Oh, maybe. Oh, no, we're all good now. Oh, we're all good.
Yeah, fantastic. Great as always. Well, thank you, Dave. Really appreciate you being here tonight. Now, we are going to have a great time talking about tax and how amazing that there are so many people already. I mean, it's not even hit 7 p.m. and there are already 260 people on this webinar ready to talk about tax. And the good news is you guys have found your way to the webinar chat. Now, there is one thing that I will ask you to do just before we get started, which is I see a lot of people are sending their chats to hosts and panelists. And so in your little chat frame, there should be a drop down. Where it says hosts and panelists, please click it, please change it to everyone so that everybody on the webinar is able to see and talk with you. And in that way, what that means is we're going to have a great time. You're going to be able to talk back and forth with each other as Andrew and I are bickering as we've already started doing before. Now, let's rip straight into it, Andrew, because we are going to talk about some really exciting things today. Let us start at the very beginning. It is important to mention tonight that this is a webinar, so it's not personalised financial advice. While we will talk about lots of situations, just bear in mind that if you want to think about your own property portfolio and how much tax you have to pay, you'll want to talk to a financial advisor, you'll want to talk to an accountant, but we are going to give you a lot of things to talk about today. And we are so excited because there are heaps of new people here tonight. There are over 2,900 people registered for tonight's webinar, just a touch under 3,000. Hopefully, if you've got your kids sitting next to you, get them to register so we get it up to 3,000, because that would be really awesome. Almost the biggest webinar we have ever had here at Opus. And so, because there are so many people here today that are new, you might be thinking, why should I listen to these two guys? Firstly, we run the Property Academy podcast, which is New Zealand's #1 business podcast. And we are so pleased and so proud of it. We've had over 8 million downloads, almost 8.3 million downloads since we started that podcast almost 5 years ago. We've done over 1,675 podcasts. We've done over 50 of these webinars. We own New Zealand Property Investor magazine, and our book is currently in bookstores. Now, I never say any of this to brag or say that we're the best to know everything. We don't. It's just so that if it's your first time tonight and you're thinking, can I trust the information that I'm about to hear? Hopefully, this gives you the confidence that you can. Now, my name's Ed. I'm an economist here at Opus Partners and a property investor. And I do want to talk about something a bit difficult today. I saw on Reddit.
Oh, this made me laugh.
It made me laugh too. Somebody said on Reddit that their podcast is like listening to Tony Alexander if he didn't know how to breathe through his nose, which I replied that I thought it was actually pretty funny, even though they're talking about me. And I put that there today just because I am a bit under the weather. So if you think, oh, Ed sounds a bit sick,
particularly nasally. He is, and coughing all over me, so he's sacrificing it tonight. I'm going to be sick for the next week, but here we are.
Yeah, so if I sound even more nasally than usual, you know why. Now, I'm sitting next to Andrew. He's a financial advisor, managing director here at Opus.
Soon to be sick.
And a property investor as well, owns over 30 investment properties. So he certainly knows what he's talking about when it comes to property investment. Now, tonight, you're going to get the webinar for free. We're going to do a Q&A at the end. We love doing it. Stick around for the Q&A. One of the best parts of the night. We'll stick around for about 20 to 25 minutes answering your specific questions. And you are going to get the recording for free as well. That'll be sent out tomorrow. And I know there's going to be people who come in late. They're going to say, is there a recording? Is there a recording? Yes, there is. You'll get it about midday to early afternoon tomorrow. It'll be available on YouTube, on our website, and also the Property Academy podcast feed. Now, a couple of things. As I said before, to get the most out of this webinar, put your chats in the chat and make sure you put any questions you want us to see in the question box. Now, that is really important because Andrew and I, as I said, we're going to be bickering away. We're going to be talking back and forth. And you might have a really good question. And to make sure that we don't lose it, please put it in the Q&A box. And on top of that, to make sure you can chat back and forth, send your chats, send your messages to everyone, not just hosts and panelists, because there are going to be hundreds of property investors here tonight, and one of the great parts of this community is you guys talking back and forth live on a Tuesday night. Now, we're going to do something very fun today. We are going to go on a drive around the block to talk about all of the different tax changes in New Zealand. So come on, buckle up, jump in the big red car, because we are starting brom brom in Sesame Street, and we're talking about our first tax. Andrew, what is the first tax?
Okay, the first tax that we've been faced with over the last wee while for any existing investors or people who have bought over the last couple of years is this interest deductibility rule. And the really easy way of understanding this is if you bought a property in the last couple of years, you were paying tax as if you didn't have a mortgage. So you might have a massive mortgage on a house, but the IRD considered it a non-deduction, so you were paying tax as if you didn't. And think how profitable our rental properties would be if you didn't have a mortgage. It'd be huge, right? But good old Nicholas Willis came in, party pooper, popped the balloon of Grant Robertson. Did you make his mouth go to a frown there?
It did go to a frown there.
Good, there you
I
go.
didn't do it, our graphic designer did, but yeah.
And so he's gone off to the University of Otago. Interest deductibility is being phased back in. So if you've got a mortgage which wasn't deductible, you're going to be able to have some deductions over the next couple of years.
And it's important to recognise these changes have come in from the 1st of April. So they are very, very recent. Now, you might wonder, how do these impact me as a property investor? So, Andrew, we've got 3 townhouses behind Grant Robertson. Let's get rid of him. And what we can see is that these 3 townhouses are all exactly the same.
Yeah, so I'm going to show you 3 examples of investors that have got the exact same property value, exact same mortgage, and the exact same rent. So you might be thinking, surely the tax for each of these investors is the same. Well, that's not correct, because it all comes down to when they bought their property and what they bought. So let's look at Oscar the Grouch. I can relate to someone like Oscar the Grouch today, who's sick, can't tell you what his name is, we'll call him dead.
So Oscar the Grouch, he bought his property in May 2021. So what are the tax rules for him and how are they changing, Andrew?
So because he bought in the period where there was no deductibility at all for new investors, people that were buying an existing property within that time frame, there was 0% deductibility. It was as if he had no mortgage at all. Now, as of this financial year, he's now got 80% deductibility, which means he's going to pay less tax.
Now, we're about to go through some numbers. If you're not a numbers person, stick with us. We're going to give you the key takeaways, but I know some of you guys really love digging into the detail. So, Andrew, walk us through what interest deductibility actually meant for Oscar the Grouch.
So the rent that he was collecting was 35 grand a year. His operational costs, so what I mean by that is rates, insurance, maintenance, accounting, property management, those costs, 11,000 a year. The mortgage, there was no interest deductibility at all. So even though he's paying a mortgage, none of that was a deductible expense as far as the IRD is concerned. So his taxable profit was $24,000. Now, if he's on the 33% tax rate, Oscar pays $8,000 out in tax, but remember, he's still got a mortgage.
And that's the most important thing. He's still got a $600,000 mortgage, but none of the interest costs count when calculating the profit, so it looks like he's making a lot of money. But if he's even paying 6% on his mortgage, Andrew, he's still got $36,000.
Is that at 6%?
At 6% is what we've calculated these numbers on.
Which is a pretty generous interest rate. 36 grand goes out in interest, and now he's got a cash flow deficit of 20 grand a year, which we're seeing that kind of top up for a lot of investors at the moment. So $20,000 that he has to pay out under the old rules. What does it look like now with deductibility at 80%?
Well, the most important thing to recognise is his operating costs. His rent stays exactly the same, but 80% of his interest costs now count when calculating that taxable profit.
So the great thing is now, from a tax perspective, he's not making a profit, so there's a loss, no tax to be paid. once we take out that mortgage, which is exactly the same, or the balance of the non-deductible part, his cash flow is negative $12,000. So the reason it's negative 12 is because he was paying $8,000 in tax that he's no longer paying, which is pretty big savings.
So it's got to be about $8,000 better off. What does that work out to be per week?
Works out to be $150 a week, give or take, better off from a cash flow standpoint that Oscar is going to face now with the new rules.
Is he still grouchy?
He's still a bit grouchy.
Yeah, I can imagine so. Okay, let's come down to the next house on Sesame Street. This is owned by Bert and Ernie. Is that us?
Yeah, well, we've been referred to Bert and Ernie, or the chefs, quite a few times.
Well, we'll take it. What are the rules there?
So now they've bought a property right before the changes came into place, so they still get some deductibility. Rather than getting none, they get 50% deductibility, or they were getting that. Now, under the new rules, they too go to 80% deductibility. So let's run through those numbers again.
Now, it's important to recognise exactly the same operating costs, exactly the same rent as our first example with Oscar the Grouch, but they were still making a taxable profit, weren't they?
A small taxable profit of $6,000. Again, they're paying $2,000 in tax. Their non-deductibles are 18, so their cash flow is negative 14. Now, under the new rules, they get another 30% worth of deductible expenses in their interest. So now their taxable profit is 0 and their non-deductible 7.2. Their cash flow as well, same as Oscar, is negative $12,000. So they've got a benefit of $2,000 worth of tax savings that they were going to pay, but they're not going to have to pay this year.
Okay, so how much better off are these guys over a week over the next year?
They work out to be about $40 a week better off because they're only getting a 30% extra deduction rather than 80%.
And again, Oscar the Grouch and Bert and Ernie, their properties the same. The mortgage, the same. The rent, the same. The only difference is when they purchased the properties, they had slightly different tax rules, and that is the reason why when Nicola Willis comes out, pops the balloon, changes the interest deductibility rules, that's why they get slightly different outcomes. The Oscar the Grouch is slightly better off than Bert and Ernie from these changes.
And actually, one thing to point out is that there was a definitive line in the sand. It was the 27th of March 2021, right? And if you bought the day before that, then you got 50% deductibility. If you bought the day after, you got 0 deductibility. So some investors just had this moment where a few days made a huge amount of difference in terms of the amount of tax they were going to pay.
Okay, well, let's come back and come to the next part, our next part on Sesame Street.
Next?
Well, we're looking at townhouse number 3.
Oh, you got the count. The economist of Sesame Street.
The economist of Sesame Street. Now, he bought in May 2021, but he's got a different set of rules, Andrew. Why is that?
So because he bought either a new build with 100% deductibility or he's renting to social housing, which also gives him the exemption, his account has got 100% deductibility, and so that doesn't change. He carries on his 100% deductibility into the new financial regime. Now, the benefits for him are going to be less because right now his taxable profit's negative 12 and his tax is 0. That is going to be exactly the same this financial year as it is last financial year.
And so the important thing to note here is he wasn't paying any tax anyway. When the rules change, he's under exactly the same rules. So for the count, nothing really changes. So let's just compare them again, Andrew. Looking at our 3 people here, we've got Oscar the Grouch is $152 a week better off, Bert and Ernie $38 a week better off, and the count is no better off at all. Now, here is a question for you all sitting at home. One of the things we love to do is put together polls for you. And so our question is, who would you rather be? Now, don't type it in the comments section yet or the chat. We're going to put a poll across your screen. Would you rather be Oscar the Grouch and be $152 a week better off? Would you rather be Bert and Ernie and be $38 a week better off? Or would you rather be the Count and be $0 better off at all? This is as a property investor. So I'm going to put that poll across your screen now, and we're going to see what you guys think. So what do you guys think? Would you rather be Oscar the Grouch, Bernard Ernie, or the Count? I can't wait to jump in and have a wee discussion.
It's really interesting because we can see the answers so far. We'll wait a wee bit for people to have this. I thought people would have gone a different direction, but they've gone in the direction that I would have agreed with.
Yeah, how fascinating. So we've got almost 500 of you guys so far have answered this poll. Once we get up to about 500 or 600, we're going to see what everybody thinks.
Samantha Spratz just asked a question, but Samantha, can you put that in the Q&A and we'll answer that at the end because it looks like quite a good question.
Yeah, great question around ring fencing. I'm going to close that poll off in 3, 2, 1, in that poll, and I'm going to share the results with you. So about 535 of you guys are saying, look, I want to be Oscar the Grouch. Some of you are saying Bernard Ernie. The bulk of you are saying the Count. Now, what's your read of this situation,
well,
Andrew?
I can understand when you look at the numbers, you think Oscar the Grouch is getting the highest benefit, so I want to be him, right? But the Count, he's been exempt from paying this additional tax over the last couple of years. So to have that benefit and now just have that continue, he's actually the one that's financially better off, even though his tax situation doesn't change much.
Yeah, there'd be a lot of people that say, as you guys have, hey, yeah, I want to be Oscar the Grouch. But actually, if we look at it, if we think about the amount of tax they were all paying before, Oscar was paying the most tax, followed by Bernard Ernie, then the Count wasn't paying any. When you look at what happens after the rules change, they're actually all even, right? They're all paying the same amount of tax, which is going to be $0 in this specific case. So it almost doesn't matter which way you go. But if we would personally choose the Count because he has been paying the lower amount of tax over the last couple of years and has had that benefit. The reason Oscar gets the biggest benefit is because he's the one who's paid way more tax over the last couple of years. Now, here's a question that I've been asked, Andrew, from a couple of journalists recently, and I'm going to throw it to you. So if we think about Oscar, he's $152 a week better off. Should Oscar pass those tax savings over to his tenant? What do you reckon?
So I would have loved to have actually had a poll on this. And I feel like the media has been putting out there, and certainly because this has been dressed up and promoted as a tax break for landlords. And don't get me wrong, it is a tax reduction because there's an unfair tax at the moment. In my opinion, there's an unfair tax for landlords. But the situation for Oscar, as well as any of those investors, is they're all making a loss. They're just not making a loss and then paying tax on top of their loss. And so I don't think he should reduce his rent.
Yeah, there was a really interesting comment, I suppose, we got from a listener of the show when we were talking about, well, should property investors lower their rent because they've got this tax reduction? And they said, look, I'm going to go from losing money on my investment property plus having it to pay tax on it to just losing money on my investment property without having to pay that tax bill. So certainly, just because there is a reduction in tax doesn't mean automatically for a whole heap of investors that there's more money in their back pocket, that there's more money in their bank account to then afford to lower that rent for their tenants as well. So that's what I just wanted to mention about that. Rightio.
Where are we off to now?
Well, we're leaving Sesame Street.
In this car?
It'd have to be me. I'd be the better driver.
You're a terrible driver.
So we're going to Diagon Alley. That's right. We're going to
What's Diagon Alley?
We're going to the Wizarding World, Andrew.
What do you mean?
We're going to Harry Potter, the Wizarding World.
I haven't seen it.
And the reason we're talking about Harry Potter is both Harry and Hermione have been investing in apartments recently, and they've been Airbnb-ing them out. And again, as of the 1st of April, Airbnbs face a tougher tax, and it's all down to a change in the GST rules. Let's dive through it. So let's say Harry has been renting out this apartment on Airbnb. He has been charging $230 a night. Now, previously, he's not had to register for GST, and therefore he hasn't been charging any GST.
Why not?
Because his property earns less than $60,000 a year, and therefore he doesn't need to be GST registered. Now, really important change here. The GST rules have changed, but he still doesn't have to register for GST. This is really important to understand, and I had a great question from long-term listener of the show, Stephen, asking about this. After these GST rules change, after the app tax comes in, as it already has, Airbnb will have to pay $30 of GST on that property, on Harry's property, every single night somebody stays in it, because now it will be subject to GST. Now, what's really important to recognise, though, is that Harry still gets some of this GST back. So if Harry actually went out and got GST registered, yep, he'd have to pay GST, but he would also be able to claim back GST on everything he spends on his property. That includes rates, that includes some insurance, that includes his electricity. So although he doesn't have to register for GST, some of that GST goes to the IRD, some of it comes back to him. That sounds really complicated, so here's a really easy rule of thumb. Effectively, it's about a 5.7% pay cut per night. That's how much you can expect less to get if you don't do anything for your Airbnb. What does that mean for him a week? Well, let's say he's been renting out this property for $230 a night and he's got occupancy of 70%. So 70% of the time he's got somebody staying there, 30% of the time he's got nobody staying in there. So all up, he's getting currently about $1,100 a week in terms of rent or fees from people staying in his Airbnb. He's going to pay about $64 extra in tax if nothing changes, right? $64 a week under the Airbnb tax. But what becomes really interesting is when you think about the combination between the Airbnb tax and interest deductibility. So let's talk about Hermione. So she owns exactly the same apartment as Harry, same details as the Sesame Street, $800,000 property with a $600,000 mortgage. And what happens for Hermione? Well, she's going to pay $64 a week in the Airbnb tax, but she actually gets $101 back extra through interest deductibility. So the IRD is giving in terms of interest deductibility, but they're also taking away in terms of the Airbnb tax. Now, for Hermione, all up, she is going to be $37 a week better off. So it's not enough to just think about the Airbnb tax or interest deductibility as if they're separate, because they're going to impact you both, or they're both going to impact you if you're renting out your property through Airbnb. But there's one other important change. So let's now move to the side of somebody who rents out an Airbnb. Let's say you are Ron now, and you want to go and rent out Hermione's property. Now, what's interesting, on the 1st of April, Airbnb changed their website. And what did we see? Well, you've got the nightly rate for Hermione's apartment up there, $211 a night. But look at the taxes.
Moly. So they've increased the taxes down there.
Yeah, so they are passing the taxes on directly to the customer. So, and this was one thing that we couldn't tell before the 1st of April. What was Airbnb going to do? Were they going to take away my rent as an Airbnb, somebody who rents through Airbnb, or were they going to pass it on to the customer? They ended up passing it on to the customer.
So if I understand that correctly, they've decided that their people that are renting properties out are their customers, and so what they've done is they've passed it on to the consumer rather than the people that they're receiving revenue from.
And what's really interesting when you think about it from the person who rents an Airbnb, so when they're scrolling through, they're seeing $211 a night. But then there's a cleaning fee. And then there's the Airbnb service fee. And then there's the taxes on top of there. So when you're scrolling through your Airbnb app looking for an Airbnb, Ron sees $272 a night, or discounted down to $211 per night, but actually his final cost is going to be $374 a night. Now, what does that mean? Well, as somebody who emailed me just today said, they said, I tried to book an Airbnb over Anzac weekend. There was going to be an extra $63 in tax on top of the cleaning fee, the Airbnb fee, the nightly costs, and so I'm going to stay in a hotel instead.
So that's interesting, because now you've got a bit more of an even playing field for Airbnb renters versus a hotel. All of a sudden, for the hassle of it, maybe I just go book at the Hilton.
And so people might say as well, Ed, you said before that it's going to be 5.7% less revenue for me, but it's actually being passed on to the customer. So is it really? Well, what I'm expecting to happen is a lot of customers, like the person I just showed you who emailed me today, they might start to move away from Airbnb, starting to say, actually, I'm going to go stay at a hotel where I get a minibar, where there's 24-hour check-in. I know, the minibar's really important for me. I stay at a lot of hotels.
Or the hamburgers you said before.
Oh, yeah, room service. Maybe that's something that you really care about. So you're like, actually, for the same price, because it's an extra $40 a night or an extra $60 a night, bugger this, I'm going to go off and stay at a hotel. And so you might see Airbnb owners saying, well, I need to decrease my nightly rate a little bit in order to make sure that I've actually got some vacancy, because you might see that the forward booking calendars start to just dwindle down a little bit. So I've got a question for you guys again. I'm going to run another poll. So if you owned a property that you rent out on Airbnb, what would you do this week? Would you keep the daily rate the same, just to see what happens? Would you put the daily rate down to try and get some more bookings? Or is it, honestly, I don't really know, Ed. I'd have to wait and see what happens. So I just want to get an understanding of where you guys are at. What would you guys personally do? I'm going to put that across your screen now. We're in Diagon Alley, and there's over almost 900 people.
Have you read all those books, have you?
I haven't read all those books. I've watched all the movies. Yeah. I've read probably 2 or 3 of the books, I think. And what's fascinating is I can already see that there are a lot of people. This is really split. It's split down the middle almost completely. And I find it really interesting what Mike is saying there. He's saying you've got to look at the full cost before booking Airbnbs. Most people compare motel, hotel, Airbnb prices and facilities. I totally agree. You've got to look at the final cost, because it's not until you added the Airbnb service fee, the cleaning fee, that you really see, oh my gosh, Airbnbs are way more expensive.
What do they call that in economics? It's a substitution product or something like that. It's very easy for us to be able to substitute out one for another, right?
A hotel for an Airbnb. Yeah. That's absolutely true. And we're going to stop that poll in 3, 2, 1, and I'm going to share the results. And it is pretty evenly split. Yeah. So 34% of you are saying, I'm going to keep the daily rate the same and see what happens. 36% of you are saying I'm going to pull the daily rate down in order to try and get more occupancy. And about a third of you again are saying, actually, I have no idea what I'd actually do. And I really love that honesty as well. So we're pretty evenly split here about what happens with the Airbnb tax. But the thing I want you to focus on is you've got to think about the interplay. If you're renting out your property on Airbnb, you've got to think about the IRD giveth through interest deductibility, and they take it away through the Airbnb tax.
You can tell you're a little church boy, aren't you?
Well, both of us were, Andrew. We both were. So let's come to Evergreen Terrace now, because we are going to talk about another type of tax, and specifically we are talking about the Bright Line.
So the Bright Line, for everyone, anyone that doesn't know, is kind of New Zealand's version of a capital gains tax. We don't have a capital gains tax, but we've got an income tax that's linked to the timing of when we buy and sell a property. So who have we got in Evergreen Terrace? Well, we've got Homer and we've got Flanders.
Ned Flanders. Which one are you? You're Homer in this situation, aren't you? Because I've got glasses, so I can be nerdy Ned.
Right. So they both bought a property at the same time again, so exactly the same situation for the setup.
And now we're both thinking about selling our properties. Now, Andrew, were you allowed to watch The Simpsons when you were a child?
Not really. I think
what do you mean, not really?
Well, so in the Nickel household, we're very religious, and we weren't allowed to fill our head with that kind of garbage. Now I watch all the garbage I want.
Yeah, I wasn't allowed to either.
Weren't you?
But then, when I got old enough, I rebelled and I watched The Simpsons.
That was your rebellious streak.
That was my rebellious. Now, one thing you need to know about The Simpsons is they set it in Springfield. Yeah. And the creators of The Simpsons decided to set it in Springfield because that was one of the most common town names in the United States.
Really?
So that you wouldn't know exactly where Springfield was. It could be anywhere. But I tell you what, we have found Springfield, and it turns out that it's in Christchurch.
There is a Springfield in Christchurch.
Is there?
We're kind of Canterbury.
Yeah, okay, well, we'll go with that.
All right, we'll go with that.
So what if they both bought their properties in March 2020, Andrew?
Average property value then was $514,000. Seems cheap now, doesn't it? And then we fast forward to March 2024, it's now worth, the average property, $762,000. So there's been some, even though there's been a dip, there's been some serious growth in a 4-year period.
And so what does that mean in terms of the bright line test when it changes, Andrew?
Okay, so remember, there were different timings of the bright line. When it first came out, there was a 2-year test. So if you bought and sold within a 2-year period, you paid tax on your profit. Then there was a period where it was a 5-year test, and now it's a 10-year test. Well, sorry, currently it's a 10-year test. If you buy a property, you've got and it's an existing property, it's 10 years before you can sell it without having to pay income tax. Now, that is changing. The new bright line test works like this. As of July 2024, the test is 2 years. So if you bought before July 2022 and you sell after July 2024, you're outside of the bright line test, which means you don't pay tax unless you're tainted or caught up in some other way.
Yep, so we're going to go back to a 2-year test. So it's really important to recognise if you currently have a 5-year or a 10-year test, that goes back to 2 years. You're not stuck with the 10-year test forever. You're not stuck with a 5-year test forever. So Homer Simpson hears this and he says, great, I've had a 5-year bright line test. If I sold under the previous rules, then I would need to pay tax when I sell my property. But now I'm going to be outside the test. This is great. I'm going to be able to sell, no worries.
So he goes out there and puts up gets hardcourts to sell the house.
And so what happens there, Andrew? Because he decides to sell June the 2nd.
Okay, so he sells June the 2nd. So the rules haven't enforced. His increase in value, the profit is made. The profit before cost is $248,000. You deduct your sales cost, so there's about $38,000 by the time he pays a real estate agent and his lawyer, maybe a discharge fee. His tax rate, he's on a good tax rate, isn't he?
Well, he works for the nuclear power plant.
Yeah, okay, high risk. So he's on the 39% tax rate. His tax at that is about $82,000 that he's got to pay.
But wait a second, I thought that he was going back to a 2-year bright line test and so he wouldn't have to pay tax.
Now, here's the thing. It hasn't changed until July. Now, the other part to that is it all determines when you sign that contract as well. So you've got to be really careful. You don't want to go out there and get the property listed. You might sell it or sign it on the 2nd of June, settling on the 1st of July or the 2nd of July, so you fall outside of that. But because you sign that contract on the 2nd of June, Homer is paying his tax.
And so this is so important. If you're thinking about selling a property right now and you've got a 5-year or 10-year bright line test, be really careful. You do not want to be selling that property before the 1st of July because Homer only gets to keep I say only, but it's $128,000. It's a lot of money.
But it's almost half of the profit, right?
Yeah, 61% of the profit, because he's still going to pay almost $82,000 to the IRD. Now, Ned Flanders, he's a bit of a nerd. He's a stickler for the rules.
That sounds like you.
And so he decides to sell on the 2nd of July. What do the numbers look like for him?
So, increase in value, exactly the same. Sales costs, exactly the same. The tax is zero. So he gets to keep $210,000, a significant amount more than Homer because he didn't sell the property until after that date. And that's really, really important.
And so just because they've chosen to sell their properties on slightly different days, they get vastly different outcomes.
What's your best Flanders impersonation?
I couldn't do it.
Come on, you can.
No, I'm not going to do it because you're just going to make fun of me. And I know you're setting me up. But I think the main thing here is, where would you rather that $82,000 be? Would you rather it be in your bank account, or would you rather it be having to transfer it to the IRD? We all make our own choices. Personally, I prefer to have $82,000 in my bank account rather than pay it in tax, in my personal
You're just going
opinion.
to donate it to the church anyway. I know how you work, Ned Flanders.
Yeah, thank you, Andrew. Rightio. It sounds like a tax deduction to me, though. So let's say that we are going to leave Evergreen Terrace now. We've talked about the bright line test. We know it's changing. And now we are going to Baker Street. And when we go to Baker Street, we are talking to Sherlock Holmes. So we're moving around.
You've got very creative this month.
Well, I thought we'd go through all of the most famous fictional streets. And the reason I thought it'd be just a little bit of fun for everybody while we talk about tax. Here we go. So we're here at Baker Street, and one of the big questions I'm getting at the moment is, Ed, should I invest in a new build or an existing property? And so Sherlock is an investor, property investor, and he's thinking about growing his portfolio. And he says, with all of these taxes changing, with new builds and existing properties being on pretty much the same even keel now, because new builds don't have these massive tax advantages, should I now go and buy an existing property? And so Sherlock decides to research the market, and he wants to look at both the pros and also the cons of both new builds and existing. And I think this is really important. So when he looks at the pros of a new build, he says, well, it's a really hands-off strategy. It's really low time for me to get in there, purchase something. I don't have to get it and renovate it. There's not going to be a hell of a lot of maintenance, and therefore it's going to be a low time, low effort strategy. He also says, well, it takes less money to get started. I only need a 20% deposit rather than a 30% deposit. Well, actually, it's currently 35%, soon to go down to 30%. And he also sees that the funny thing about property investment strategies is that all properties can have the highest return depending on how you measure it. Now, if you use the return on investment method for measuring your property investment profits, new builds tend to get a better return on investment. The reason for that is you put in a lower deposit, but you often get the same amount of capital growth out. And so you get more capital growth for the deposit you put in. But they're not for everyone. You see, Sherlock also sees that as part of his research, he can't renovate a new build to increase its value and to increase the rent he can charge. He says that there's often less land, and, important here, they have a lower yield. So these are two different ways of measuring property investment returns. And new builds will outperform on return on investment, but they will underperform, generally speaking, when it comes to yield. And the reason for that is because a new build is a little bit more expensive because everything is new. You were going to jump in here,
Nothing about DTIs in there.
We're going to come back to DTIs. We're going to talk about DTIs because they're not currently in.
No,
so,
but you changed about the 30% deposit, so I just wondered.
Yeah, okay. We'll come back to that.
All right. Okay, Sherlock.
He then goes and looks at existing properties, and he sees that the pros are the opposite of the cons for a new build. He can renovate to add value to an existing property. It will have more land most of the time, and it probably will get a higher yield, but similarly, the pros of a new build are the cons of an existing property. It's going to be more of an active or hands-on strategy. It's going to take more time to get in there and renovate, to create a renovation plan and then manage it, even if he gets experts in, like a licensed building practitioner, a plumber, an electrician, to get in there and do all of the work. Even if Sherlock is not on the other end of a paintbrush, it still takes some time. Some other cons, it's going to take some more money to get started. 30% deposit plus some renovation costs, and same thing we said before. Yep, existing properties often get a higher yield, but a lower return on investment because you've got that higher deposit. And so Sherlock's got a decision to make. Should he go for a new build or an existing property, understanding both the pros and the cons? And one of the things that Andrew brought up before is debt to income ratios. You see, what's underpinning this question of should you invest in a new build or should you invest in existing property is all about government regulation. So we've got Benedict coming back in.
Have you watched that one?
I've not watched that one.
Oh, that's the best one.
So in both 2023 and 2024, new builds have the advantage of lower deposits. So 20% deposit versus a 30 or 35 or a 40% deposit. But what's changing is the amount of tax you pay. So because of the interest deductibility rules, in 2023, 2022, 2021, new builds paid, in some cases, significantly less tax compared to an existing property. And we saw that with Oscar the Grouch. Oscar the Grouch bought an existing property. He was paying so much more tax compared to the Count who bought a new build. But in 2024, they're paying the same amount of tax. That benefit of a new build has been taken away because the rules have changed. And so that is why Sherlock's thinking, well, should I buy an existing property instead? What he's also got to weigh up is debt to income ratios. So later on this year, the Reserve Bank is going to bring out new rules which make it easier to get a mortgage for a new build compared to an existing property. And that's because existing properties have to face the debt to income ratio rules, whereas new builds won't. And so it's the same thing we were talking about in some ways with the Airbnb tax. You've got one benefit coming in or one incentive coming in for you to buy a new build, but there's also an incentive going away. And what you've got to do is weigh up, well, how much do I value these incentives? Which do I care about more? And therefore, it's kind of up to each of us to decide, should you go and buy a new build or should you go and buy an existing property? And one thing I want to mention as well is it comes down to how Sherlock wants to spend his time. Does he want to get in and renovate a property and manage that renovation, or does he want to spend a lot more of his time solving criminal cases? And so what we often see is if you're in a job where you've got a bit more flexibility, where you've got some time after work to get out and renovate, hey, look, going and buying an existing property and renovating it could be the right thing to do. Personally, I don't have as much freedom as in my job because sometimes my boss acts like the count and I spend a lot of time at work. Because I'm very focused on that and building a business, that means that I don't have as much time to go and renovate existing properties, so I choose new builds. And so it kind of comes down to what strategy do you want to follow? Do you want something more hands-off, or do you want something a little bit more hands-on when you get in there and renovate? And I can see you want to jump in.
Yeah, I do think also the DTIs will probably have a big impact on a lot of investors. So if you want to buy one property and you're happy spending a bit of time renovating that property and you're going to make more money doing that, then absolutely you do that. But if you're a passive investor who's maybe a bit more limited that needs multiple properties, it will be easier to borrow for a new build than an existing property as well. So it kind of depends on how ambitious your goal is as well.
Yeah, and the truth is that there are going to be people on this webinar who decide to go and buy new builds, and there are going to be some people who decide to go and buy existing properties. It's really up to you guys what you actually want to go and do, because all of you can be successful depending on which strategy you choose and whether you commit to it. And so one thing that I really encourage you to do is what Sherlock's going to do. He's going to go and watch this excellent video we released on our YouTube, which goes through new and existing properties, talks about which is the best investment. That is on our YouTube channel, Opus Partners. If you Google Opus Partners YouTube, it'll be the first thing that comes up. And it goes through the 7 big differences between new builds and existing properties.
And actually, there's a comment that someone's made saying that certain banks don't scale rental income, so discount rental incomes in their servicing calculations if the property is new, so it may make a difference. I do think that'll change. I think it'll all be an even keel. The reason they brought in that additional shading or additional discounting of rental income was because there was extra tax to pay for existing properties, but that will change.
Cool. Well, I want to hear from you guys and see where your heads are at. I'm going to put another poll across your screens and ask you, what do you think? Which do you prefer investing in? Do you prefer investing in new builds, existing properties, or actually both, depending what the time's happening or what's going on in my life at the time? So new builds, existing, or both, depending on what the better investment is. I'm going to put another poll across your screen to get a sense of where all of our heads are at, and that is going live now. So, Andrew, any other comments you're picking up in the chat before we reveal these results?
Brody did also make the comment that you can buy a new build property with as little as a 5% deposit. That's very rare. So I just want to point out for any other people that read that, if you are buying to live in yourself, you might get a mortgage for 95%, but it's very unlikely. You're correct, Brody, in saying that there is no restriction for LVR requirements or deposit requirements for a new build, and that will continue. But also there's what is restricted by the Reserve Bank and what is decided by an actual bank who's lending the money. So I don't think we should ever rely on those kind of numbers.
And the last thing I just wanted to mention is I saw a great comment from, I think it was Craig. Craig said he prefers new builds because he's lazy. Well, I wouldn't say that you're lazy, Craig.
Busy.
It's that you value your time, or you value other things rather than renovating properties. And the truth of the matter is some people just think, why would anybody buy a new build? I want to renovate existing properties, and that is awesome. And if that's your strategy, absolutely go for it, mate. That's just wonderful. But some people say, you know what? I want exposure to the property market. I want to grow an investment portfolio, but I don't want to be actively involved. So I'm going to end that poll in 3, 2, 1, and I'm going to share the results with you again. So 33% of you are saying new builds, that's what I'm into. About a quarter of you are saying existing properties, and actually the largest section is saying 44% of you are saying both at the right time, depending what the property is, depending how it all stacks up as well. Now, what are you getting a thing about? Oh, Andrew didn't follow my rules. And he had his chat set to hosts and panellists rather than everyone. So he's been chatting away.
Producer Dave just pointed out that I've been talking to ourselves.
To him and me rather than you guys. It's because he never listens that Andrew Nickel, does he?
What'd you say?
Yeah. So what we're going to do now is, because we realise that, you know, some people are going to invest in new builds, some people are going to go into existing properties. We are going to go into question time in a moment. But what I do want to mention is that even after recording 1,600 odd podcasts, 50 webinars, and subscribing to New Zealand Property Investor magazine, and even reading our book, a lot of people still ask, what does Opus do? What do Ed and Andrew do here at Opus? And I just want to talk about it for 2 minutes, because there are a lot of you here tonight, over 3,000 or almost 3,000 people registered for it. And if you've never heard about us, you might think, I don't actually really understand what Opus does. There are 2 big things we do. First of all, we help you create a property investment plan. And so this is an example of Andrew sitting on his hotel room in the QT in Auckland, working with an investor. I think he was living in Singapore at the time, and he's creating a property investment plan in our software called My Wealth Plan. And I think we've got a new version of that I'm going to introduce you guys to maybe next month. The second thing we do is find new builds for you. So that would be appropriate for about 75% of the people listening to this webinar right now. For the 25% of people who prefer existing properties, you know, this specific service would not actually be the right fit for you, because we mainly focus, or we solely focus, on new builds. These are the 2 main things that Opus Partners does. And it's really important to recognise, I love saying this, you do not have to use Opus, right? There are lots of companies like us. If you Google property investment companies, yeah, we'll be the first people that comes up, but there are other people like us. There's Propeller, there's Positive Real Estate, there's Property Factory. These are all companies that are very similar to us and do a very similar thing. There will always be some differences, but pretty much similar. And so a lot of people will say, well, why would I specifically use Opus rather than somebody else? And I think there are 4 main reasons that I just want to mention. The first is that we use by far the most data to help you make an educated decision. And hopefully you see a little bit of that here tonight, where we're doing a lot of nerdy number crunching and modelling. The second thing is we've got a lot of properties that you won't find on Trade Me. A lot of developers will say, hey, I've got some new builds, I want to move them off market, I want to find some buyers, potentially offer them at more attractive prices than I would to the open market, and so I want to go through you guys. So we've got a lot of properties you won't necessarily find on Trade Me. On top of that, we try and get good prices and good deals. And you might say, well, how do you evidence that? Well, every single property that we recommend to an investor has a table like this. It has comparable properties that show you exactly what other people are charging, that show you exactly the number of bedrooms, that show you the exact street address, so that you can do due diligence and say, well, is this really a good deal? Is it a good investment, or are they just trying to tell me it is a good investment? We try and evidence that so you actually have the confidence to know you're making a good investment decision. And the last thing, for people who decide to go with Opus, the big thing for them is that you can get all of your support in one place. That means Opus Partners helping you find the property, Opus Property Management managing it for you, Opus Mortgages getting the mortgage, and also Opus Accounting now doing the accounting for you. Now, that doesn't mean that we're the greatest thing since sliced bread, because we're not the right fit for everybody, and some people will look at this list and say, actually, Ed, that's not what I'm into. But for the people who like us, those are the 4 reasons you might decide, I'm actually going to go with these guys. Now, I'm not going to chew your ear off, this isn't a hard sell, but if you want to take this further, I want to offer you a portfolio planning session. Now, there's no cost for this, $0. Our entire service is actually free. The reason is because we get paid by the developer if you decide to buy a new build through us. And what that portfolio planning session is when you will use our software, a bit like what Andrew was doing on the floor of the QT when he was working with that investor in Singapore. And that's an example of Ben, another one of our financial advisors, walking through an investor through their plan as well. So if you're kind of interested in that, if you're thinking, yeah, Ed, wouldn't mind having a wee chit chat with you guys, I'm going to put one final poll across your screen. And it's going to say, are you keen to book in a free or a complimentary planning session? And if you click the top button and says, yes, send me a link, then we will send you a link tonight. And if you click the bottom one, then you won't get a link. So if you click nope, I'm good right now, you're not going to get a link. And I promise you, I won't be offended. That's absolutely fine. So just so you've got the opportunity to say, yes, I'm keen to take this further, or nah, it's not for me. I'll just put that last poll across your screen right now.
While we're doing that, I'm frantically typing to Sage. Sage said the 3 C's of property investing are cash flow, capital gains, and capital improvements. New builds only give you capital gains. If they only gave you cash flow, if they only had cash flow, I'd be all over them. Sage, so you can buy a new build with really, really good cash flow, high yielding properties, and you do buy properties for capital growth. That's how most investors make their money. There's investor groups that you'll join and they'll always talk about, oh, the cash flow isn't that good. It doesn't matter how good the cash flow is. 90 or 80, 90% of people's profits from investing in property is from cash flow. Speculating, that is just the way it is.
Well, it's not speculating. I hate it when you say it's speculating.
No, but that's what it's called in those groups. So capital growth is the thing that people make money out of, that, and you can get good cash flow out of a new build. You're right. You cannot make money through capital improvements. That's just not something you get out of new builds. But one thing I would say is there's actually a third. I started typing this. There's a third C.
You mean a fourth C?
Fourth C, and it begins with L, and that's R, restrictions. There are government restrictions now. Who you can rent your property to and what sort of standard it has to be, the banking restrictions. There are still tax restrictions, deposit restrictions. There's a whole lot more than that traditional way of thinking, and I know because I've been doing this for 20 years, it is not as simple as just saying there are 3 C's to investing, because there aren't anymore. Anything else to add?
No, all I want to say is, before we jump into the Q&A, if you want to take this further, 3 things you can do. First of all, listen to our podcast, Property Academy. It goes live every single morning. Episode 1678 was live this morning. Tomorrow morning will be 1679. That happens at 4 a.m. every single morning. Today's was about tainting and when you actually might have to pay even more in capital gains tax, or where you may have a more restrictive setting. Tomorrow is going to be about should you lower your rent after interest deductibility comes in. Because you guys have listened to this, you'll know that Oscar the Grouch probably isn't going to decrease his rent because of the tax rule changes. Second thing you can do, subscribe to our YouTube channel, Google Opus Partners YouTube. There are 2 new videos every single week on a Monday and a Wednesday. What is tomorrow's about, producer David? Interest rates. What's happening with them? Are they decreasing? It's a really good one. It's pretty quick and fast and furious. I recommend that one. And then also check out our book, Wealth Plan. That is currently in bookstores, or you can get it at wealthplanbook.com, and there is free shipping all across New Zealand. I'm so pleased to tell you we have sold 5,000 copies, which is a very popular book in New Zealand. Most books in New Zealand are lucky to sell 1,500. And so we're so happy, we're so grateful for everybody here who has bought a copy, and even more grateful for everybody who has decided to actually read it as well. Right, we are going to rip into Q&A and ask you what else you would like to know. Now, there are a couple that I actually already know that I want to jump into.
Well, I'm just going to do this one quickly. Someone's asked about Opus accounting and whether or not they can use that even if they haven't used Opus to buy their property or they've got an existing portfolio. And someone asked for some advice around what they're like. Opus Accounting is a new company, but for an existing service. So we owned a company called Momentum Property, or we own 60% of that, which was a strictly property investment accounting service. We bought out our business partner this new financial year, and so now we're 100% of that business, and we're really excited to put in a whole lot of systems to make it a better journey for you if you're a property investor. But don't get me wrong, if you're a business owner and you need advice around your business returns, if you've got really complicated structures, we're not going to be the right fit. If you're a property investor, that's your side business, and you've got a job, we're going to be an excellent fit for you because we're going to specialise in those property investment returns. But that's probably the difference. And on the website, it actually has a video of Ed and I talking about who we're right for and who we're not right for.
Yeah, Natalie's asked a great question. She said, do you work with other mortgage advisors? So the great thing is you could use Opus Partners and Opus Property Management and not Opus mortgages if you don't want. So you can use any of our services you want or any you don't want. Now, let's get into some technical questions. There was a great one today that came from, I think it was Stephen, who is one of our long-time webinar attendees. He said, hey, look, with these change in GST rules, am I potentially going to get caught up when I sell my property and have to pay GST on my property transaction? The answer is, Stephen, no. Because, or not necessarily, but talk to your accountant. Because under the GST rule change, the Airbnb tax, you will pay some GST, but Airbnb is the one who is GST registered, not necessarily you, right? And so you do not necessarily have to go and get GST registered. In fact, for a lot of people, going and registering for GST will probably not be the right fit, because your property, when you eventually sell it, may then get caught up in the GST net. You may actually find that you've got to pay GST on that, and therefore that is something to look out for. You might not want to get GST registered. Have a wee chat with your accountant. There was another one that I got over email that I just want to answer. They said, Ed, I was thinking about buying a new build, but under these rules, doesn't my deductibility go from 100% down to 80% for the next year? The answer is no, it's 100%. So you're staying at 100% over the next year if you buy a new build. Everybody else is gradually coming up. So even if you buy a new build today, it's still going to be 100%. It doesn't go down.
Okay, let me do a couple of. Samita said, does the IRD refund you some cash at the end of the financial year when you file your tax returns for your investment property when we've got interest deductibility? Now, this is actually a different rule called ring fencing. So there's a lot of questions around ring fencing. Do we expect that to change? At the moment, if you make a loss in your rental property portfolio or with your rental property, that doesn't offset your personal income and therefore give you a taxable refund. So the answer to the question is no, you don't get a refund, but the losses are still valid. Those losses carry forward because one day your property will make a profit. And if you're caught by Brightline and you make a profit, that can also be used to offset the amount of tax that you're going to pay. So those losses are there, they're just not paid to you against your other incomes because they're ring fencing. Do we think that's going to change? Absolutely not anytime soon.
There was a really good question as well from Mike that says, what's the income ceiling for GST? What's the point where I have to register for GST? $60,000 a year is the answer for there. Same for accommodation as everything else in New Zealand.
But the app tax is for everyone.
And the app tax applies whether it's through Airbnb, Book a Batch, Batch Care, or any of those platforms. What else is tickling your fancy in the questions, Andrew?
Someone said, is tax deductibility valid for a first home or a homeowner or just an investment property? Now, this is a good question because over in America, you can actually make a deduction against your income because of your personal mortgage. Now, in New Zealand, we only tax if it's an income-generating asset. So you've got to be earning an income for there to be a taxable profit or loss. Now, rental properties have an income, so therefore there's a taxable benefit or cost. With your own house, there is not.
Now, there's a lot of questions, like from, I hope I say it correctly, Marika, who says, can we deduct rental losses from our salary and wages? Same with Tanya saying, are Airbnb properties still subject to ring fencing? The answer is no, you can't do that. The rules were changed back in about 2018. You cannot deduct rental losses against your income and get a tax refund. Not anymore.
Oh, Di Foster, one of my favourites, has said, does the 80% go to 100% at any stage for Grouch and Bert and Ernie? So if you've got existing investors, people that have got properties already or have purchased within that horrible 2-year period where there's no deductibility and now they're at 80%, yes, from next financial year, everyone will be at 100%. It will all be the same no matter if you're a new build, an existing investor, or you bought within that 2-year purgatory period. And actually, another question that comes from that, someone said, Bert and Ernie and, who was the first person?
Oscar the Grouch.
Oscar the Grouch. They're all good until Labor and Greens get back in and wind this all back. Now, I'll tell you what I think about this and Ed will tell me if he differs in opinion. that rule, the interest deductibility phase out, was very unpopular. So the government consulted with IRD, Treasury and...
Ministry of Housing and Urban Development.
Yeah. And all three of them?
Oh, God, you're taking me 3 years.
At least 2 of 3,
yeah.
but probably 3 out of 3 said, do not do it. It is a terrible rule. The government did it anyway. So I don't think any government in their right mind would come back and reintroduce something that was introduced against all the advisors' opinions and then wound back. I don't think that would happen.
I don't know about that though, Andrew.
Don't you?
No, and I'll tell you the reason why. Because governments go against official advice all of the time, and every shade of government does it because they can come in and they've made political promises and they will go ahead and do things. You know, just because Treasury says no, they'll then come out and say Treasury's wrong.
But do you think it's likely?
I think it's likely they'll have another go at some point.
Okay,
absolutely.
Interesting, okay.
Like, there will be a range of different taxes.
Well, let's put a wager on it.
Well, I will. I can't wait to get paid out for my next wager. Now, there's been a lot of questions in the comments that says, why don't you guys deal with existing properties? Why is it that you only work in new builds? And I think it's such a great question. I want to answer it openly and honestly. The main reason is we did in the past. So for about 2 years, we had our Opus Accelerate service, which helped people renovate properties. Now, we ended up closing that down and selling that business to our business partner at the time, Ilse Wolf. And there were a couple of reasons for that. The first was that there were very bad tax rules for existing properties, right? We had interest deductibility, and even though we had a sense that it might come back, it was still pretty tough going. The other thing is existing properties only made up about 5% of our client base. So we did a lot of webinars, and it took a lot of effort, but we didn't necessarily get a lot of customers out of it. And the third thing is I just released a really good YouTube video talking about the problems with Opus partners, right? The problems with property investment companies, all of the things that are bad about our type of companies. And I go through negative reviews on Reddit and actually talk about them. If you look at all of our negative reviews, or most of our negative reviews about our company, a lot of it was about the existing service. People saying, I paid $20,000 or $23,000 for the service, but I don't feel like I really learned a lot new. Now, I'm not knocking what we were doing. I'm not knocking my ex-business partner, Ilse, because she still runs that business. It's really great. But I know that some people would pay the money and not necessarily always get what they wanted out of it, because it's really a coaching service rather than a knowledge delivery service, and we already put out so much knowledge live anyway. So because it only made up a small portion of our client base, because there were really bad tax rules, and because that's where more of our kind of not hugely negative, but reviews that weren't totally positive were around that side, we thought, hey, that's actually not for us. We're just going to keep giving away our information for free.
I think the other thing that I would add to that is Opus is a mature business now, where this is our, we'll be turning 11 years old in August. And when I started the business, I'd already been investing for 10 years. So I'd done a lot of that hands-on investing in existing properties. And that worked really well for me as a young person with no kids and fixed hours that I worked. Now that I'm a lot busier with children, and my daughter as well, as I said, and I now don't have the time to be able to be focused on the hands-on approach to get the most out of existing properties, and you do have to be a bit more hands-on. Similarly, I've invested heavily in older properties that have cost me a lot of maintenance. Now, I know for the majority of people we work with, they want a bit more certainty, and they're prepared to pay for that certainty around their maintenance costs and the warranties that come with new builds. So it's a tactical decision around the type of people that we're wanting to work with, who want a more certain outcome from a portfolio over a period of time.
Now, it's really important to say, hey, if you're investing in existing properties, I still want to work with you through Opus Mortgages, through Opus Accounting, through Opus Assurance and Opus Property Management, but the core property coaching service won't be right for you. Now,
and
you've got a question
there.
there.
Fraser's got a question, which is a great follow-on from that. What's your biggest advice for a teenager looking to get started in investing in property? Fraser, it's the complete opposite of what we're talking about here tonight. Ed and I were fortunate enough to be invited to the Lincoln University the other day, and we did a big presentation on Opus Partners, what we do, how people invest, how people invest, and then we told them all to do the opposite. You need to be doing property trades. You need to be buying properties, finding ways to improve values, selling them, probably paying income tax on that, paying the bright line tax, taking that money and reinvesting it. You need to be growing your wealth through very active strategy, not the right strategy that we're talking about tonight, or not what we're talking about. You need to be very hands-on, and you need to repeat that process until you can transition to a passive strategy.
Okay, so let's jump into some other questions. Just for somebody who said, I missed the beginning, is the recording available? Yes, it is. It's going to go live tomorrow on the Property Academy podcast feed. It's going to go live on our website and also on YouTube. YouTube will be a little bit later on in the week. So let's come to another question. Jane's asked, what if I rent out the minor dwelling on my property as an Airbnb, and I'm GST registered personally, but not for the Airbnb? Now, Jane, I've got to tell you, I'm not an accountant, but my gut tells me that GST is in regards to the purpose of what you're doing, or the taxes generally apply to the spirit or the purpose of how you're making money. So my initial reaction would be to say, probably don't have to pay GST, but I would just check that with an accountant rather than listening to an economist who is not an accountant. Let's come to the next kind of question, Andrew, which says, what is the bright line test for new builds under the new rules?
A bright line test for new builds, everyone's going to be the same. So everyone is going to be the 2-year bright line test. There is not going to be an advantage or a disadvantage for new versus existing.
Yeah, that is absolutely correct. What else is making you a bit interested in here? Pick one while you choose one. Somebody says, please take a wild guess. How many times will banks let you buy new builds outside the DTI rules when they eventually come in? Well, according to the actual rules, the DTI does not apply to you at all. So you could keep going for as long as the banks will allow you to. But I'll give you an even better answer. So there was some really interesting modelling. I'll just find it in one of our recent webinars. I think it was in the February webinar, where we looked at somebody who currently owns one investment property and asked, well, what would they be able to do if they bought a whole heap of new builds? And the Reserve Bank actually has released some modelling around this, and I will just pull it up because there's a really good graph that I want you to be able to see. Let me just find it. Here we go. Going to share that with you now. So what we have here are how many properties you could potentially buy under the DTI rules. And what we see is that over the next 10 years, according to the Reserve Bank's modelling, you may be able to buy up to 6 more new builds over the next 10 years, compared to about another 3 existing properties. So over 10 years, given a whole heap of assumptions, a whole heap of modelling, go back and watch February's webinar to find out what those were, but you might be able to buy another 6 new builds over the next 10 years compared to another 3 existing properties. So that gives you a really good sense of how much faster you could potentially grow your property portfolio. But it does come down to some of those assumptions, so jump in. What else are you seeing, Andrew?
There is...
You're not very good at picking questions today.
Sorry, there's a lot going on in the chat as well that I'm trying to answer. Definition of a new build, is the house 2 years old or less? So the definition of a new build under the rules for deductibility is code compliance came out on the 27th of March 2021 or that day forward. And then you had 20 years of that being considered a new build. So if your code compliance came out 27th of March 2021, you were a new build. No, was it 2021, 2020? 2020.
It was 27th of March 2020.
2020, because they rolled it back a year. And so you've got 20 years from that date that's a new build from an interest deductibility standpoint. But again, everything's going to be in the same camp as of next year.
Yeah, the other thing that's really important to talk about is what counts as a new build from an LVR perspective, because there are some developers out there who are selling new builds, but when it comes to going and getting the mortgage from the bank, it will not be considered a new build. So from the Reserve Bank's perspective, it is 6 months after the code compliance certificate has been issued. So let's say there's a developer out there, they finished a property on the 1st of January 2023 and the CCC came out. It's no longer a new build from a deposit standpoint. It is no longer a new build when you, from the bank's view, when you go in and say, can I please buy this with a 20% deposit? No, you can't, because the CCC, the code compliance certificate, is now too old. So that is something to look out for as well. The LVRs and the debt to income ratios, they will have the same rules. So same thing applies when it comes to DTIs. When they come in, if a developer got the CCC 1st of January 2023, won't be a new build from a DTI or a deposit standpoint. That is something really important to understand at a time where a lot of developers are finishing stock but not necessarily selling them.
Chris asked the question, and again, I've tried to choose things that have got a similar theme. Maybe I misunderstood, but comparing new versus existing, ROI return on investment seemed to be tied mostly to capital gains. This is what he's asking. And rental income considered separately under yield. Now, I just want to make this clear. So the reason the return on investment is higher on an existing property than, a new build than an existing property is it requires significantly lesser deposit. Right now, 35% deposit for existing, 20% for a new. That's why, because you're putting in less money that you're getting a return on, you might end up with a higher return on investment for a new build. But often you might pay less for an existing property, therefore the yield might be a little bit higher. What we do is we use a return on investment spreadsheet that takes everything into account, and you can download that on our website and put all your details in, and it will work out the different levels of returns you're getting. So it's going to look at deposit you put in, the cash flow you put in, so the total input versus the capital growth you get and the rental income that you get after costs over time, and then what works out to be the higher return on investment. Just remember, if you're using that, you need to put the percentage of deposit that you're required. So 35% right now if it's an existing property, 20% for a new build.
Great, let's come to another one. Somebody saw, do you do any work in Australia? Now, just be really careful with your mic, Andrew, because if you rub your jacket, it comes through. Justine asked, do you do any work in Australia? No, but we've been thinking about it, Justine, so it's really interesting that you're thinking about it. I'd love to hear from you. What sort of work would you like us to do in Australia? Send me an email, ed@opuspartners.co.nz. It'd be really interesting to get a sense of where your head's at.
Just to be clear, we work with Australian investors wanting to invest in New Zealand. We just don't do any work with New Zealand investors wanting to invest in Australia, just in case it's that way around.
Anonymous attendee says, Ed, has your ROI spreadsheet been updated for these interest deductibility changes? The answer is yes. So you can download it now, opuspartners.co.nz/ROI, and you're going to be able to get that. Just for anybody who hasn't seen that, because some people were asking, well, how does all of this interest deductibility work? I will show you the exact spreadsheet that you can download as well, so you can just get a sense of what's going on. So if you go and download this spreadsheet for free, I will just show you here. You can pop in all of your details of your property, where it is, whether it is a new build or whether it is an existing property under Nationals policy rather than Labour's policy, under Nationals policy. So that's 80% and then 100%. And then if you put in all of your details about the rent, the costs, all of this good stuff, you get results, which talks about exactly what the ROI is. So we assume some capital gains, we assume some debt repayments if there are any, maybe some instant equity if you buy, undervalue or renovate, and also cash flow. And so when Andrew is talking about return on investment, we're talking about all of the returns divided by all of the investment, and then you get a single number out with which you can compare different properties. You can download that for free, opuspartners.co.nz/ROI. And let's take maybe 3 more questions, Andrew. What's the first one that you're jumping into? Jun, just to answer your question before Andrew jumps in, does the spreadsheet include 80% deductibility? Yes. What's jumping out for you? 3 more questions. I'll jump in and take one then. Somebody's saying, will I pay tax if I sell my home down the track? Jane, important thing for you to realise there is your home is not subject to the bright line test because of the main home exemption, and so no, you likely wouldn't. You got another one, or you want me to jump in?
Someone said, what's your thoughts on everything being sold as an auction? The reason is the market is currently has got a lot of upfront costs. So we actually have some podcasts on how and when you might use different sales processes. So one of the great things about our podcast is we've created this massive database, and on our website you can actually search for different things like auction, and it will show the podcast that relates to deadline sales auctions versus price by negotiations. I'd go listen to that.
And then lastly, Daniel, you've said, can we do a portfolio planning session with your team here at Opus Partners if we want to do both new builds and existing properties, i.e. renovation? The answer is yes, you can. Sure. Just head to our website, click the big orange button at the top that says book your free session, and you're going to be away laughing. There was one other that I wanted to jump to. It was in the chat, and I really liked it. Somebody said, can you still claim expenses on an Airbnb property under the new rules if you're not GST registered? So the answer is yes and no. So if you are not GST registered, you can't claim back the GST that you pay on your rates, insurance, maintenance, all of those kinds of things. You will get some money back from the IRD, but you can't claim things back. When it comes to your income tax, of course, absolutely, yes, you can claim some of that back. Any one last one before we wrap up?
You said last one.
No. Awesome. We are going to be back next month in the month of May, and we're specifically going to be talking about how you plan for retirement and all of those kinds of things. We've got some brand new software that I cannot wait to show you, and we're going to go through a whole heap of examples. So stick around for May next time. Thank you so much for being with us. We really appreciate it, and we will see you again next month.
Thanks, guys.